Welcome back, everybody. It's good to have you to another real estate market update for the Greater Milwaukee Area, this time December 2022. This is always the time of the year where I like to look back and recap a little bit what has happened this year. And oh my God, it has been a roller coaster of a year for sure. And then also look forward and see what can we potentially expect from 2023 based on the data that we have today, on the knowledge that we have today. As you know, market predictions and forecasts are always a little bit iffy. It's like the weather report, but we have some data that will give us some idea at least to understand how we're going to start out this year. And one of the major influences is going to be mortgage interest rates for 2023. And I want to take you a little bit on a deep dive why a lot of experts are thinking that current mortgage interest rates are artificially inflated and why they are supposed to come down somewhat in 2023 and what impact that will have on the market, where it is going to create opportunities for buyers and where it's going to create opportunities for sellers so you can plan and strategize for the upcoming year. But before we get there, let's take a quick look at the latest data from the MLS. As always, let's start out here with inventory. So we had a little bit less than 3,400 units on the market. That's still very, very tight inventory compared to a benchmark year in November 2015. You can see that still a lot less in inventory. A lot of people had expected that the market will soften, that inventory will start to pile up, that this will create motivation for sellers and lowering prices. We have not seen any of that. Inventory remains still very, very tight, and basically everything that goes on the market is selling still relatively quickly, much faster than in the rest of the US. That's also something I want to talk about a little later today. In terms of homes sold that actually closed in the month of November, we are down massively compared to last year, a big fat minus 35% here. That is a huge decrease. But when you put it a little bit in context and you look back what was normal in November 2015, then you see 16, 17, 1800 units is kind of normal. It was the last year that was actually the outlier where we had such a crazy hot market that was fueled by very low interest rates at the time. So the velocity on the market is still extremely fast. 10 days is the median. 62 used to be a normal number in November of 2015. So most homes that go on the market are still selling very, very quickly. And that means also competition is still relatively fierce. I just was involved this weekend on a transaction where they had a total of 11 offers. So still very competitive. Not for all deals. So, at this point, I have to maybe correct this a little bit. This is rather the exception. So we're seeing a lot of transactions that are going with one offer or with two offers at the most. But a good listing still has the potential, if it's very attractive, to go with multiple offers. And that's what we're still seeing. So what does that do for prices? Median sold price still at $280,000, and that is still up 7.7% over the same month last year. You always have to be very careful when you hear about real estate prices that you're comparing year over year, because we have a very strong seasonality with prices. If you've been following my market updates, you know this. I've been talking about this a lot. Prices are the highest in spring, summer, and then usually falling off into fall and winter. So this is well within the normal range that would we expect for this time of the year. And compared to the same month last year, we're still 7.7% ahead. And Milwaukee is doing quite a bit better than the national average. That's also something that I have some slides for you in just a little bit here. So overall, the market remains super strong, still very, very, very competitive, and buyer demand is very strong despite the pressure that we have seen from mortgage rates. It's gotten a lot more expensive to take out a mortgage. And of course, a lot of buyers have moved to the sidelines for the moment. But even with many of them gone, we still have a very hot and very fast-paced market. Let's take a look here at new inventory. So there is, as every year, a seasonal decline in new listings. So this is not total inventory. This is listings that are coming on the market every month. And as you can see, we always have the peak here in May, June. Usually this year it fell into June. And then from there on, every month, fewer and fewer listings are coming on the market. So if you're currently looking on the MLS, if we have set you up with an MLS access, then you have certainly noticed that there's less new inventory coming up. And it's kind of the picked over stuff from last summer that is still out there in inventory, but not much new hitting the market. in terms of what can we expect going forward, it's pretty much going to be a pattern like this here. So this is a question that I get a lot from buyers around this time of the year. When do you expect inventory to increase? So January is usually going to be slow, then it starts coming up here in February, and in March is when it really starts that we see more and more spring listings. So that's an opportunity for sellers, because if you understand that seasonality, you can kind of beat that curve and be on the market earlier before all the competition arrives on the market. So you have a lot more eyeballs, a lot more offers, a lot more showings on your listing, because there's just not that many out there. That's the opportunity for sellers, just to beat that curve and be ahead. And on the buyer side, you have to be a little bit patient and wait for inventory to pick up. And most importantly, you have to be prepared, and you have to have a good plan and a good strategy, because this time of the year you have to be very quick. If something good pops up, it will not stay on the market very long. Then here's a little bit about pricing, and I have two curves here. The first one is a new list price, and then the green one is sold price. So what this is showing you, that in spring we had a disconnect between what people were listing homes for and between what they're actually selling. And then in the second half of the year, the two curves have gotten much more aligned. So buyers and sellers are kind of agreeing on the prices where they are, but they are higher than we would typically expect them. So if you look back at this curve in previous years, you would see that typically it would come down here. That is not happening this year. We are basically going sideways here, maintaining a relatively high price level, and buyers and sellers are somewhat on the same page on where that should be. All right, before we get into the 2023 forecast, here's a quick segue. I want to sensibilize you on headlines that are taken out of proper context about clickbait. A lot of that is designed to actually grab your attention and sounds very spectacular. But a lot of my subscribers are actually clients of mine. So if you're watching this, I might see you at an appointment or at a showing later this week. And it is very important for me that you are armed with an actual understanding of what's really going on in the market, and not with emotions and stuff that is based on clickbait. So I have two examples here to show you what's going on. This tweet, for example, said homeowners have lost $1.5 trillion. It's a huge amount of money in equity since May. And homeowners are losing equity at the fastest pace in over a decade. That sounds really alarming if you don't understand what these numbers mean. And this is data actually from Black Knight. You can see it here. They're actually quoting them. So I've dug up the data here from Black Knight, and here is what it actually is. So this is home equity in $1 trillion. And we have here Q1, Q3, and the third quarter of this year. And you can see, yes, in the third quarter, we have lost compared to the second quarter, but overall, we are still quite a bit ahead of last year of 2021. So this is well within the normal seasonality. And this is designed to really grab your attention and make you alarmed about something. And there is really not that much to be alarmed. Actually, I would say this is very healthy that this number has come down a little bit. And in that context, 1.5 trillion are actually not that much. Now, the next example that I have for you is, you may have seen in the news a little bit that the number of foreclosures has doubled. And when you look here, that is kind of true. Since 2021 to 2022, that has doubled. But look at the numbers that we have seen here. 278,000, 700,000 used to be kind of the norm before we enter into the Great Recession. And then what we all remember is 2 million foreclosures in a year. So yes, we have doubled in a very short amount of time, but overall, we are still on a very low level here. All right, so what can we expect from the Milwaukee real estate market in 2023? In order to get at least a sense or an idea in which direction the market is moving, let's take a look at some macroeconomics. And the first one that I have here is inflation. We just have gotten the latest reading here from the Consumer Price Index on December 13, and it came back at 7.1%. That is the second month in a row. If you remember, last month we were at 7.7 and I was cautiously optimistic, but I said 1 month doesn't make a trend. It's just a data point. Now we have 2 months here. So that is actually a good thing. This is moving in the right direction. Inflation is very, very important, very impactful in the housing market for a number of reasons. Number one, it's driving Fed policy, and Fed policy directly and indirectly is impacting mortgage rates. It's setting the tone for the housing market. But inflation has also very tangible impacts, because if consumer prices are going up, people have less money in their pocket that they can use for a down payment or that they can allocate towards a monthly mortgage payment. And it also tends to stress people out if gas prices over $5 a gallon and they just don't feel in the mood of making a change, and they just hunker down in where they're currently at and they're waiting it out. So inflation has a huge impact on the housing prices psychologically, but also tangibly. And that's the reason why we want to keep an eye on that and see where this is going. If inflation continues to soften, as it currently looks like it would, that is quote unquote good news for the housing market. So that means it will make the housing market hotter and more competitive. If inflation remains elevated, that is going to create different issues, and it will also have an impact on the housing market. So very important to keep an eye on this. The other thing that is really impacting the housing market is, of course, employment. If a lot of people are losing their jobs, that means they are not interested in buying a house, and that slows down the real estate market. Now, the job market is very interesting right now. I've never seen something like this. Normally, you would expect a scenario where you have unemployment a lot higher than open jobs. So 10 years ago, we had about 12 million people unemployed and about 4 million people looking for jobs. When you look right now, it's an inverse situation. We have 10 million open jobs and 6 million people are being currently unemployed. So for everybody who's unemployed, there's more than one job waiting. The Fed has actually stated as a goal that they want to raise unemployment rate in order to cool down the economy. So they actually want to crack that. But it looks like we have a ways to go here, even though with the latest tech layoffs that we have seen with Meta, with Twitter, and with a number of other tech companies, they usually are the early ones, so we will see who is following. But we have so much buffer in the job market with there's so many open jobs that it will be a long time before we are going to see the unemployment rate change in a meaningful way. So positive signals from there. Speaking about unemployment rate, so we have an issue in Wisconsin that we have a very low unemployment rate. I have it here on the screen, currently 3.3%, which is less than the US as a total with 3.7%. And this very low unemployment rate is creating an issue because employers cannot grow their companies, their businesses, if they are not able to find workers or people for the office that are able to help them grow the business. And one of the reasons they're having issues is because we just don't have the housing to accommodate more workers. So the Wisconsin Association of Realtors, the WRA, has been lobbying for years now in Madison in order to change this. And you can see on this historic chart very easily where we have been. The orange line is giving you single family buildings. So you can see here we peaked at about 30,000 units, new construction every year in Wisconsin. And the long-standing average was kind of between 25,000. And then we dropped down here and we're still not producing meaningful new housing inventory. We need more workforce housing. And this also comes here from the blue line, which is lots and subdivisions created. So we had this level here historically, and now we're down on this here. And of course, you need to create land and lots first before you can build houses. So this is kind of a conundrum, and it also shows that the demand is here. There is pressure on the market to create more inventory, more houses being built, but that is just not happening. And this is why the WRA is lobbying to make it easier for builders and to create legislation that will actually create more housing and that will bring the competition down and also help to moderate with prices. All right, next let's take a look in motivation. Do people actually want to move in 2023? And the reasons why people are moving are different. The number one reason I hear currently is probably the need for more office space, working from home. A lot of people continue and will continue to work remotely and work from home. So they need 1 or 2 additional bedrooms to accommodate that. If you ever have tried working from home or being on a Zoom call while you have family members around you, you know how frustrating that can be. And that creates a daily stressor on families. And that really creates an incentive for people who want to move. The second biggest thing that I hear currently is cost of living. So across the US, home prices have really shot up. I'll show you some chart here in a minute. And also rents have gone up dramatically. So a lot of people say, well, I can work remotely. Why do I have to live in a high cost of living environment if I can just move to a state like Wisconsin where cost of living is lower? So that creates the motivation. And this survey found that 22% of the homeowners want ideally to move by the end of 2023. So that's 1 out of 5, and that is a significant number. And so the question is, what keeps you from moving? And when you look at the answers, 2 of the top 3 answers have to do with high mortgage rates. So that really shows how important the impact of mortgage rates is on what's going on in the real estate market. And the third one has to do with high prices. So we'll talk about prices on a national level here just in a minute. And then I also want to show you here so if rates are what keeps you from moving, what rate would it take for you to actually move? And you can see highlighted in blue that 4 to 5% and 5 to 6% mortgage rates would cost them to make that move. Now, where we're currently, so we are at the moment at 6.27%. That is the latest data after, here it is. This is the latest data after we have gotten the last consumer price reading. So it came down and continues to come down. We peaked here in early this fall at 3.37%. And you can see here in this chart marked the area in blue, 4 to 5 and 5 to 6%. This is where people feel comfortable. This is where they say, okay, if rates are going in this direction, then I'm going to move. And we have currently a lot of clients that have hit pause on their home search because they said, well, Marcus, rates are so high, we'll just wait for rates to come down. So there is a psychological component, but there is also a real tangible component when you look at affordability. And you look at a household budget. So I have here a chart that gives you in the middle we have the US median home price. So that's about $400,000. And you can see between a 7.5% mortgage rate and a 6% mortgage rate, there is a substantial difference in your monthly payment. And this is just principal and interest. So this is about $400 here in difference. And of course, that has an impact on a household budget. But you can also look at this in a different way. You can say with high rates, 7.5%, a few weeks ago we were almost there. This would be the limiting factor. And at $2,650, you could afford a $380,000 loan. But if the rate would go down from 7.5% to 6%, you can afford a $440,000 home for the exact same payment. Well, actually a few bucks less here. So there's a $60,000 difference in how much you can afford more in terms of if you have a lower mortgage rate payment. So that really shows you there is a psychological impact on mortgage rates, but there is also a real tangible family budget issue with mortgage rates. So I mentioned earlier that a lot of mortgage experts are currently saying that the current mortgage rates are actually artificially inflated. They don't need to be as high as they are. So let me explain what they mean so we can understand if they potentially have a point. The chart that I have here shows you the correlation of 30-year fixed mortgages with the 10-year treasury yield over the last 50 years. And you can see the two lines are moving pretty much in unison. The mortgage rates and the treasury yield are technically not connected, but if you want to know where mortgage rates are going, all you have to do is look at the 10-year treasury yield. And without getting too technical here, on average, they have a spread of about 1.7, something in that neighborhood. And this is where it gets interesting. So when you look at the last 21 years here, on average, we had a mortgage rate of 5.28. And that comes from the blue line, or the blue box here is the treasury yield. And then on top of that, you have the spread. So that gives you that average 5.28 mortgage rate that we have enjoyed over the last 21 years. This is the current situation. The current spread is actually 2.99, almost 3% over what the treasury yield is at the moment. So there's a very large spread. The reason why the spread is so large is because the banks are saying there is a lot of uncertainty in the market. We don't know exactly which direction it is going. And also we know that a lot of people that are currently buying our mortgages are going to refinance into lower rates in the future. So that's why they're getting a bigger spread at the moment. And so where would we be if that spread would be the 1.79, the historic average? We would be currently at about 5.5% mortgage rate. And this is the logic why a lot of mortgage experts are saying we're currently inflated. All right, next I want to take a look at Milwaukee prices versus national markets. Very colorful chart here. I have it from Redfin. And I want you to look here at the red line because this is the national median home price. And that is currently still at a little over $400,000. And there's a lot of markets that are much, much more expensive than the national median. There's also markets that are lower. For example, we are here in Milwaukee with just a little over 200,000. So you can see there is a big difference between median prices in Milwaukee and what is the median price on a national level. And then, of course, we have our high-flying markets on top of that. Of course, we have Los Angeles here with super high prices. Then a real high flyer over the last few years was Seattle, that had a spectacular run here with prices going up. Also Boston, very expensive. Washington, D.C., very expensive. So all of these markets are much higher priced than the national average. So what are the experts saying about national home prices for 2023? So this is for the US in general, not for Milwaukee. And you can see here we have a wide range of opinions. On the more optimistic side, we have Realtor.com and the Home Price Expectation Survey. Also, the National Association of Realtors and Mortgage Banker Association are optimistic that home prices are going to gain in value next year. On the more pessimistic side, we have the government, Freddie Mac and Fannie Mae here, slightly negative. And then Selman and Associates, Ivy Selman is the most pessimistic at the moment with minus 5.1%. So the average of all seven is slightly positive. You see it in green here on the left side, 0.4%. So that goes to show how difficult it is currently to predict the real estate market for 2023 because there's so much uncertainty in the market. So you have a wide range of opinions. But there is also the fact that markets are going to develop differently regionally. So the Wisconsin or the Milwaukee market may develop differently than other markets just because some of these markets have gained so massively in price, also in rents, by the way, have gone up so much that they are in a much, much different situation in terms of affordability as we are here in Milwaukee. We have still a very, very good affordability, and therefore the downward pressure on prices is not as high as it is in some of the other markets. Personally, and I'm saying this very, very carefully, personally based on my experience and where I'm seeing how I see Milwaukee performing in November and in December, which is stronger than I would have typically expected it for the last 8 weeks. I'm slightly positive for the Milwaukee real estate market. I think we are going to see net gains next year. Of course, not as big as we've seen them in the last 2 years, but I'm in the camp of the slightly positive one, so I would not be surprised if we finish 2023 with slightly higher prices than we have seen in 2022. But that remains to be seen. So what are the expectations that I have or that we can have for the Milwaukee market? First of all, the spring market will really depend on mortgage rates. So that will have a huge impact if rates continue to go down and a lot of the people that are currently standing on the sidelines are coming back into the market. We will end up with a very, very competitive market. If rates go sideways, the level of competition will be a little bit slower. But I do not anticipate that we are going to see prices come down in 2023. At least that is currently absolutely not in the data. There is an opportunity for sellers. So if you're thinking about selling your home in 2023, a listing in February and in March might be a very interesting strategy. Because if you go back to I think it was the second or third slide, you can see how low inventory is going to remain in February and in March. So this is a very, very interesting strategy to just be out there early and take advantage of that because you will have a lot of eyeballs on the listing. You will have a lot of people coming to showings. There's going to be more competition, more buyers per listing than we are going to see later in the spring season when there's more listings on the market. So the whole playing field levels out more. For buyers, it's going to be an interesting market. You definitely will have to be prepared and patient. You need every little bit of advantage and just stack everything in your favor, stack the odds in your favor. Every competitive advantage you can gain will be helpful. Be prepared and be patient and enter that market knowing what you're doing. 2023 will be a challenging market. It will be a skill-based market and a very technical market. So with that being said, here's one of my favorite quotes: luck favors the prepared. So it's not too early to start making your homework, to start digging into the data and understanding what's going on. Everybody's situation is, of course, different, and it's very difficult to give general advice. So if you want to chat with me more about your personal situation and your personal strategy for 2023, then definitely reach out to me. You can get a hold of me on my phone. You have my cell phone number here, or you can just send me an email with your specific questions. I'm always happy to hear from you, and I'm always happy to answer questions. And if you want to, we can hop on a phone call and we can talk a little bit more what might be a good strategy for you for 2023, considering your personal circumstances. That's basically all I had for you, and we're finishing this year. Thank you very much. If you've been working with us, you have made us or helped us to be very, very successful this year. The whole team is very grateful that we were able to work with you. And with that, wish you happy holidays and a prosperous new year. Thank you much.